Welcome everyone to 22 Minutes in Lending. I'm your host, Vince Passione. I'm excited to introduce our guest, Tony Boutelle, the CEO of Origence, previously CU Direct. Tony has over 30 years experience in the credit union industry, including working with the Colorado Credit Union League and CUNA Mutual Group, before he headed to the California Credit Union League in 1994, where he formed CU Direct Corporation in 2002. Origence now includes 1,100 credit unions, representing 59 million members and 19,000 dealers, and has helped credit unions fund $418 billion in new loans since their inception. Thank you, Tony, for being here today, and welcome to 22 Minutes in Lending. So, Tony, we're going to jump right in. You founded the business in 1994, so congratulations on your 30-year anniversary. And by any measure, you were probably one of the first fintechs out there. So, and most fintechs are either, especially now, talk about disrupting. So were you a disruptor or not?
We were just kind of under the radar for a long time. We were in probably 3 states by about 2001, 2002, but really we didn't know what we had. I mean, so 94 was right when the internet was started. I mean, we had literally dumb terminals inside of dealerships back in 1994. We're going underneath their desks trying to plug in ISDN modems to connect to the platform. And we had hundreds of dealers on the platform, but really we got scale. And actually, Vince, you and I go back from the days we competed at DealerTrack and Route 1. We're kind of the front end for the dealers for their auto applications. And we actually started before DealerTrack. They started in 2001, I believe, and Route 1 in 2004. But it really didn't we didn't really understand, I think, what we had at first of all. And we were a disruptor. We were really trying to create a way for credit unions to make loans at the point of sale. And the challenge was, at that time in 94, you go to a dealership and there's a dumb terminal from Wells Fargo. There's one from Chase. You couldn't put enough dumb terminals in there to create an application for, 1,000 credit unions that we have on our platform today. So we really aggregated them onto one platform, and that really became, kind of the concept too, that DealerTrack and Route 1 have both, jumped onto from a banking perspective and kind of a captive perspective, I guess, at the beginning. And then, the whole story from there.
Yeah, it's interesting. So DealerTrack was incubated at JPMorgan Chase. It spun out. It was incubated in 99. Kevin O'Leary was the CIO at the time, and he had this great idea. I could use the internet to disrupt the current fax machines, right? And I remember I joined the team as part of the founding team in 2000, and it was just 2001, and it was pretty interesting, Tony, right? Because I felt that the big friction point was there were just too many of those terminals. They had one for every single lender,
Right.
and the challenge was, how do I get to all of them from one? Now, our solution was we invited all those lenders to become investors in DealerTrack. So we got Wells Fargo, we got AmeriCredit,
Capital
right?
One.
Capital One, all those folks joined. Now, what did you do?
Well, first of all, we started I came from a trade association, California League, and Golden One Credit Union had this little concept, and they actually had 3 patents on this thing, when we started, because it was all fax based, and that's, I think, even maybe how DealerTrack started too. But it really was, getting credit unions to invest in us. One of the things, as is credit unions are nonprofits, cooperatives, and we didn't have that kind of like fintech perspective, I guess, that everybody has more so today, even in credit unions. But we just went to the credit unions to get investors, and we now have about 115 credit unions that own our company, own Origence, and we just go back to them when we need capital. That's kind of that's how we've kind of been able to grow the platform, is through and the concept here is just credit unions, to keep they understand, stay relevant, they really have to work together. And we really came up with this concept of owning and controlling your delivery channel. And that really resonated with them. And, so a lot of them were really interested in doing that and making sure that we had a place at the table, I guess we could say, in dealerships. And, we've been able to take that story and bring it across the country. But we did get a little, we were slow in the game. I wish I would have known what we had in 94 and been able to get it going faster It was a lot of things trying to convince our board actually to go nationwide. It wasn't really accepted at first. But when DealerTrack came on, that's when we were able to kind of then say, hey, we really need to. But, I got through the West a lot faster than I did the East. So we have more to do in the eastern side of the United States to continue to grow.
Yeah, and I think DealerTrack evolved the opposite. We started on the East Coast and worked our way out west.
Exactly.
Uh, and then Route One came on the scene shortly after. And I think a lot of a lot of the resistance for us was really just the cost, right? Because dealers weren't investing much technology. I remember we did a study when I first joined, and I think the average dealer was spending less than $25,000 on what was that space that we were trying to occupy in the
Exactly.
F&I room because it was a fax machine and a telephone line, right? Um,
There's still
but
faxes today, as you know. It's kind of crazy
yeah,
how sort
no.
of, they continue in the same ways, in some ways, they're modernizing, but they're slow to get there.
Now, so you started in auto finance, but now you branched down to other verticals. So what are the verticals you're in now?
Well, like you said, we started it just indirect, it was
Hmm.
indirect only. So we had credit unions that really wanted us to provide, the full LOS platform. So we started in about 2010 developing what we call ArcOS today, which is our loan origination platform. And we have also, anything that you do on a consumer lending platform up through home equity loans is what we have on the platform today. So anything from credit cards uh, to home equity loans. So any kind of loan could be really done from a direct lending perspective. And then we have, kind of our front end cuddle that can be used. And now we're using it in other places. We can talk more about that as sort of this embedded finance concept. But generally speaking, we are focused on the consumer lending channels from all loan types for direct lending and indirect auto lending in particular.
Yeah. So just so I put it in my sort of parlance, so for me, DealerTrack was a credit portal. It didn't do the origination. It helped at the point of sale to direct credit applications to banks and credit unions. Cuddle the same credit portal, doesn't take you through origination, but gets you an offer to the point of sale.
It does both actually. So it can just be a credit application that then the credit union can use their own LOS. So we have integrations to all the big LOSs out there too. So if they want to use that, they can. But we have our LOS embedded in it too. So we have out of the 1,100 credit unions, we probably have a little over half of them that use our LOS to do it, and the other half use other parties. So that's kind of how we, one thing we've tried to do is give our credit unions choices and how they want to process
Sure.
loans. Yeah.
No, great model. Great model. And then I was looking at the site. What is Origence Lending Services? What does that do?
That's the back office processing. So there was a QSO there in Colorado, and that's where our offices are now for that. We merged with that company a few years ago, and they do, instead of having like DealerTrack does too, you have to have a big staff of people at the bank or credit union to do the stare and compare and look at all the different documents and making sure they line up and fund them, right? We have a team of people. We have over a couple hundred right now. And that's how we're doing all the Tesla loans and the embedded finance too that we're doing today. But it's all done out of Origence Lending Services. It's a division of ours. So credits that want to choose to do that, not have the staff to do the back office processing. We use a lot of document processing automation, a lot of AI too on that. So we can do a lot of that automated and just, make the fundings a lot faster too. So that seems to be a trend, outsourcing your back office processing. Very
Mhm.
large credit unions are using that today.
Oh, it's great. So tell me about the vision. So you brought together, you had this ability to go out and on the indirect channel. Now you're going to the direct side and providing full solutions, including account opening. So what's the longer term vision? Like, what do you see Origins 2, 3 years from now?
It is this concept of how do we help credit unions stay relevant in the lending game? I think, most credit unions, even the largest credit unions, like the one we were talking about earlier, I mean, they do have a lot of, challenges, I think, from being, relevant as this embedded finance kind of expands more as cars and cars get sold in a different way. So we're just trying to be the helping credit unions be in a place where their loans application might be getting started. So we call it top of funnel kind of relationship building, and how do we create opportunities for these credit unions to have their members represented, say in a Tesla application or many other places too. So that's the vision, is to, it's the, our vision is to create the ultimate origination experience, but the mission is much more involved about just connecting us to the most relevant places to get applications for our credit unions. So that's kind of the long-term.
Yeah, I used to call it, when I was DealerTrack, democratizing, right, that particular channel, right, and making it available to community lenders. Because when I started at DealerTrack, there were just the industry was really dominated by all the large major money center banks. And between the work that you did, Tony, and the work that we did at DealerTrack, right, really opened it up to really democratizing it, so all these community lenders could get access to a channel which was hard to get to unless you had road reps, right, back in the day.
Exactly.
Yeah.
And we, again, as you mentioned, our platform is called Cuddle, and it became, it became a verb. I mean, dealers would cuddle the loan, so they did see a, a way to get to credit unions, which they know, I think we've smoothed out the relationships, but back in the 90s, they had terrible relationships with dealers. It was all about stealing, undoing the
Right.
deals and flipping the deals. And we were able to create a good business relationship over the years, I think, between credit unions and dealers. And I think
Now,
that's,
it's funny that you said that you became a verb, because when I interviewed for the job at DealerTrack in 2000, my wife said, "So what do you think you're going to do?" And the CEO at the time introduced me to a good friend of his. He was a college mate who had a Ford dealership on the main line in Pennsylvania. So I went to go visit him to see what the operation looked like.
yeah.
And, I got to sit through all the different parts of the dealership. And when I went to the F&I office, they started talking about DealerTrack and the deal. And I'm sure they didn't have cut, right? And
Yeah.
and and then I went out and I did a couple more sales calls, as part of my due diligence. And I came home and I told my wife, I have to work for this company. They're a verb.
Yeah,
So
exactly. It is. I mean, when you can make a brand a verb, you've done something pretty good, right?
that's right.
That's a good thing, and by the way, the CEO, I know him really well. He's long retired now from DealerTrack, but who was the guy that started it?
Mark O'Neill.
Mark O'Neill.
Mark.
Mark O'Neill. Yeah.
Yeah.
I've met
Yeah.
him probably 50 times. In fact, one of the big things we did to try to get on the map with dealers back in, this is probably 2005 or so. We were still just kind of getting going. At the NADA, I don't know if you remember this, but we did, to get on the map, we did 300 helicopter rides for dealers. We signed them up in our booth, and Mark O'Neill ended up coming to and getting it. And I see him in line. I'm like, "What are you doing here?" But he
And
came over to get a helicopter ride too.
that was Mark, a brilliant guy, loved roller coasters or anything he was the thrill seeker. So it
Yeah.
was really, really interesting. Yeah, he did some amazing things, and certainly grew the company, and certainly the exit with Cox was just amazing for the dealers and for the shareholders. So Tony, let's go back. Account opening. Lots of discussions about account opening, especially given credit unions looking for deposits. You've developed this electronic account opening. Talk to me how it works, and then talk a little bit about how you see this positioned against the other parts of your business.
Well, it's super important today. I mean, interesting enough, we didn't have it as a really, kind of high valued product in the sense, because it wasn't that hard for credit unions to get new members, especially through indirect, I guess you could say. But now today, as you can see, the liquidity challenges, it's, getting CDs, getting new members and get new accounts opening are so important. So we have really leaned into it. In fact, we've done several new iterations of this product, and just released actually one as of today, to really make that, it's just the Amazon world we're in, right? It's how do you ask the least amount of questions, validate somebody's identity, which is a huge issue, as you know, in the whole fraud aspects of things and all the fraud that's going on in that whole product line for anybody, by the way. And how do you then, get enough information to authenticate that person and get their membership going and be able to offer them other things at the same time and then get them engaged with the credit union, right? That's also a big issue. How do you kind of flip them right into mobile banking? How do you get that? So those are the things that we do today as we use, but there's a lot of other platforms out there that have similarities, but it's all trying to use as many ways to get the data, authenticate it, and get the member into the credit union's products as quick as possible. Ours is less than 5 minutes for most members. And that's, there's a lot of information that credit unions want to get before they actually let you become a member. So I think that's part of the issue today too. But it is the
Right.
Amazon brand, right? Everything has to be done fast. And we're looking at what everybody else is doing out there. We're coming up with our ways of doing it. And I think we've got a pretty good solution for credit unions to be able to get that member, positioned right for them and get him onboarded quickly. But that's the game we're in.
Great. Let's dig in deeper on the auto side. I was prepping for the call and I was reading this Cox review of 2023. And I also had a chance to listen to your 2023 sort of, year in review. But Jonathan Smoke is a chief economist at Cox, and he talked a lot about, boy, this was really the last 2-3 years since the pandemic been really, really tough. Like lots of unprecedented things, right? We saw vehicle values appreciate at a rate we've never saw that didn't appreciate before. We've never thought that we'd see supply drop the way it dropped during the pandemic, and then obviously interest rates right at a 23-year high. And then in that same report, he's predicting that 2024 is kind of getting back to normalcy again, right? Slow growth on SAR, right? This year was like a 15.7, 15.3 million SAR. And he's kind of thinking it's going to be the same. Downward pressure on prices as a result. So increased inventory. And now this is going to be the year of the consumer again. And then on the EV side, I loved his sort of quote. He said, it's the year of more incentives, more discounting, more sales muscle. So we're kind of sitting here now looking at 2024. It all sounds great, except, listening to your year in review and with your chair and talking about 2024, right? Credit unions ended the 2023 at probably 86.5% loan to share. So liquidity is very, very tight. They're losing to the captives and some of the larger banks. So we're starting to see some of that, even though they want the loans, they can't get them. So when I think about your service, right, at the credit, Cuddle and you being probably the largest aggregated auto lender, right, in the space for credit unions, how do you help the clients get through 2024?
It's a good question. The biggest part of all this is liquidity. What you said about, interest rates and prices and how the consumer has actually been pretty resilient on all of those things, creating a much more expensive car. They're still buying cars. I mean, we're still seeing pretty good lift and probably, kind of a hangover a little still from COVID, that when they couldn't buy cars. So, like you said, that they're predicting over 16 million new car sales this year. That means that there's still a lot of buyers out there. Now it's just how do we have the funds to actually make that happen? And that's the issue that we're finding, is that credit unions have tightened up on, how much they can do in lending. So they are, they're basically replacing some of the loans they have today. So we don't have an issue really so much with demand. It's just liquidity that is really the thing that we're trying to get a sense for. I think if interest rates do come down, like I think in your notes that you sent me earlier, that, you guys are, and I think we are too, seeing maybe the second quarter that rates start coming down a little bit. We've actually seen some of the cost of funds come down a little bit. So we're actually seeing some indication of that, before it's even happening because of what the predictions are out there. But I think we'll see a much stronger second half of the year than we will first half for credit unions. Uh,
I agree.
but it is a challenging time right now, and I think the big thing is as long as we don't have any big layoffs, I don't think, and even though as prices of cars, of used cars are coming down, not super fast. If they come down super fast, I think credit will be in really big trouble. But if they do kind of gradually come down and get back to normal, then I think we're going to see a decent, I really call it, we call this a soft landing. But it is a tough time right now. Our volumes are down probably 18% from this time last year, and again, with the same kind of demand as we had last year, it's just not having the capacity to make the loans. But we are seeing some credit unions. Again, they all have a different balance sheet. They all have a different way of how they're managing things. But I mean, I've talked to big credit unions, this first couple months already, and they're all predicting half ROAs for this year versus last year, half of what they got last year. So it is going to be tough, but I mean, we're there for them. We're still keeping a good, as far as used market share goes. Credit unions have had the highest ever, and they've kept it. By the way, they haven't gone down.
Yep.
What has gone down? What you mentioned is new car financing. One, the OEMs are coming back with subvention, and two, the rates on new cars aren't as good as the rates from a yield perspective on used. And credit unions are much better at used car lending. They're just good used car lenders, and they see better yields on that. So they're really leaning in more to that.
As values bounce around, I always get very concerned about residuals. And, you see these used cars, the prices really, really got high. You had folks during COVID going out and buying cars because it was an escape mechanism for them, right? And now you're going to see those folks come back. Some of these folks took 72-month terms. So they come back as buyers, and I'm concerned there's going to be a lot of negative equity that's going to roll forward. And, and if rates come down, you kind of think there's going to be a big refi boom. Now, do you participate in that? Do you help credit unions on the refi side as
Oh
well,
yeah,
or no?
yeah. We have connections to probably a dozen different refi players, and we do help them with the processing and the connections to credit unions. So we have a pretty robust market there. But as you said, it's the only thing they can do on refis now is term, not too much on rate.
Right.
But there is a little bit still going on. But it does help reduce the payments if you can extend the term. So we're seeing some of that. But yeah, we definitely are going to be there for them, whichever market we're in. I mean, that's kind of the thing that we go through. There's always these cycles. I don't think anyone really expected this liquidity thing as much as as fast as it hit. I mean, you look at it a year ago, it was a completely different world than it is,
Yes.
so that's
Now we had Pete Hilger on a couple months back, and he was talking about the concerns he had about just defaults in the auto space. And I was pretty surprised by the numbers that he was talking about, and we're starting to see it now. What do you think's behind it? I mean, my thought was probably the summer they didn't reprice fast enough, and they got adversely selected. But aside from the overall, I get it, the economy is part of the problem, but what do you think's driving it? Because these are historically high levels of default in a portfolio that typically doesn't have this kind of default rate.
it's not really. I would say it's back to normal. The Cox economist said, I think we're getting back to normal in just all things, consumer too. I mean, really, I think if they get much higher than they are now, as far as the auto delinquencies go, I think it would say but from what I've seen and the numbers I've seen, and CNBC just came out with auto numbers I just saw the other day, and they said that they've actually leveled out as far as delinquencies go. Now, if there's big layoffs going on, I think it's all about the economy and jobs, right? If people are put out of jobs, they literally, they qualified for that loan when, even though it was a high rate, high cost for the asset, they're going to, as long as they have their job, they're going to continue to pay for it, even if the value of that car goes down. Now, if like you said, if they start turning these cars over and there's negative equity, that I think could be an issue that we gotta see if it comes to fruition. We were thinking it might start last year if rates or if prices, the values of used vehicles came down fast last year. I think you'd see a lot more distress, in the loan portfolios. But we're not seeing that much. I'm not sure what Pete's referring to. I mean, their delinquencies have definitely gone up, but we look at it from a historic perspective, they're probably close to what they were in the normal, in the
Hmm.
normal years, right? So again, I think there's a risk out there, but it would have to, I think you'd have to see the erosion of the used car pricing go pretty fast back to, it went up about what, 50%, I think, in
That's right.
COVID. And,
It's 50.
and it's probably gone down, probably it's still up about 30%. So it hasn't gone down that much, since, we kind of got back to normal. So it's slowly going back to normal. And I think that's the key
Yeah,
for,
it's got to run off. It has to.
yeah,
I agree. It
yeah.
has to run off.
But if it goes fast, it's going to be bad.
So the other thing, in which reminded me of my days at DealerTrack, is you hear that like you see the Tesla model, right? They're selling direct. You hear some manufacturers are exploring ways to go direct. And I remember, so Dave Power from JD Power was on our board at DealerTrack, and he made a statement. And he back in 2003, I think it was, and he said that the dealer franchise adds about 30% to the distribution cost of new vehicles. And Mike Jackson, who was the then CEO of AutoNation, plus, I mean, every dealer just was up in arms, went public and said, no, it's 7%. And, and he went on and on. I staked my reputation on it. Dave was almost blackballed from the industry. It was like heresy. How could you ever say that the franchise model doesn't work? So what are you seeing? I mean, because dealers are survivors, right? I mean, I look at auto
Yeah.
dealers, they're some of the best marketers in the world. They're some of the best small business owners. But what do you see happening?
Well, I think just like credit unions adding a new delivery channel, whether it's, online, mobile, the branches aren't going away. The other delivery channels are still staying strong for the most, I could tell. I mean, all the other channels just go up. I think we're just seeing new delivery channels come into play, and the traditional dealer model is just going to it will survive. I think it will, but it's going to be other channels too that come into play, whether it's, the Tesla, Lucid and Rivian, selling direct, all the new EVs and, got some that are kind of thinking about doing both, like Fisker, maybe doing actually, you know, franchise dealers and maybe doing direct. The franchise laws are a problem, but they're also, and that's a problem when it comes to consumers actually. I think they would prefer to maybe buy from the OEM, but the dealer, as you know, the franchise laws kind of keep it so you have to buy from new cars from the dealer. But you're seeing all kinds of new models where it's sort of like the agency model from Europe, where you see some of these OEMs saying, "Hey, listen, we're gonna market the cars and we're gonna sell them, but we're gonna deliver them to you guys, and you're gonna get piece of it too." So it's still gonna go through the franchise dealer. Um, and you're gonna see some that are gonna just do it the traditional way, and they're gonna keep doing it the way that they've been doing it. I just think there's going to be a lot of different flavors here. I don't know that there's going to be, one way of doing it at some point, but I do think just like, delivery channels for financial services, delivery channels for automobiles are going to just have more and more opportunities. And that's from a credit union owned, how do we keep credit unions relevant concept? Our board is very focused on, how do we embed our finance now in these different opportunities, because it's not that traditional dealer model anymore that we have. We are 100% focused on the traditional dealer model. Just to make sure that you understand that isn't what direction we're going. We know that all of them are going to stay important, but
I love the caveat.
I don't want anybody to get the idea, because we do have 20,000 dealers on our platform today, and I think that's are some of them probably going to go away? We are seeing that, the big guys are buying, buying up more and more of them. I think you're seeing some that are tapping out when they come to this EV world. I saw half the Buick dealers actually, there's 800 of them, 400 of them said, pay me off. I don't want to do this EV thing. Right. So there is going to be a big change, I think, in the whole dealer makeup, but I don't think it's going to be catastrophic, I guess you could say. I met that first CEO of Tony Boutelle. There's definitely been a lot of different approaches to this, and Cars Direct too was
Cars
another one that
Direct.
was
That's right.
yeah, yeah.
So let's switch to EVs. So the same Cox report, they said a little over 1 million, right? EVs were sold in 2023, and prediction is 24% of 24% of sales next year will be EVs, hybrids, and plugins. And you announced, and we were chatting before this about your relationship with Tesla. So tell us about it. Is it exclusive? I know you've got this new FI Connect, which we had just discussed with your team.
Well, let's kind of start with FI Connect maybe, because I think that's just kind of put in perspective this whole embedded finance concept and how Tesla wants to make loans, how, the Costco's of the world want to make any of these national organizations that are very efficient and very, very, user experience. They want to make sure that, there's just a really good user experience. None of them want a drop down box of 1,000 credit unions. They're not going to deal with, 1,000 different ways to make a loan, 1,000 different rates. So when we really met with Tesla, and it took a couple of years, by the way, to really get them to understand that we can simplify this for you. We will be the ones to do this. So we first had to get NCUA to agree to let us make auto loans. That was another thing that happened over the last couple of years. But once we got that done, we then decided, let's start a finance company. We're licensed now in 47 states. Let's try to get credit unions to, see that, again, the only way for us to play in these places, they don't like it really. I mean, they like to have their brand be out front, but if we can make the loan for you and immediately get it over to you, it's really fast how we do this, would you be willing to do it? And they absolutely said yes. So we are, we come up with the rates and the terms and all that. We do have them accept them. We don't have them debate us on them, but we do have a good process for us to get the rates and things. And then we're able to be in the ecosystem of lending for Tesla. They have us and 4 banks that they deal with, and they have an allocation engine. It's pretty much driven by rate. If we get the great rate, we get the loan. We then create an allocation engine for all of our credit unions based on membership, based on geography, all that kind of stuff. And we're able to allocate those. We actually can allow them, they can upload their members. We have most of them too, uploading their members. And if we get a match, we actually send their members back to them too. So that's the concept in that market is how do we embed our finance in some of these places? And it is not exclusive to Tesla. Amazing how many, I guess, embedded finance opportunities there are out there. We had probably 24 organizations come by to talk about that, and it's all over the place. So that is definitely a new channel, I guess, to the dealer. For many years, the application, as you know, back in the day, started at the dealership. It didn't start before it started at the dealership. Now the application starts upstream somewhere, and it may get to the dealership at some point if that's where the car is. But
Right.
there is now this whole, I think, ecosystem of embedded finance at different places, depending on the companies, whether it's, you got Amazon kind of getting in the game now too. You got everybody, looking at ways to embed the finance into their platforms.
No, it makes sense. And Tony, we covered the price volatility, but Tesla has been sort of more volatile than most, right? We saw the Model Y drop 30% over the past 3 years. The Model 3 dropped, I think it was almost 35%. Musk keeps playing around with price points. So when you think about that fluctuation, how do you guide the credit unions in underwriting this?
It's hopefully it's not going to continue. Let's just say that first of all.
Yeah, right, exactly.
It's very, I got to tell you, talk about making a few, people upset. When you have, a whole fleet of, look at Hertz buying a whole fleet of Tesla vehicles and then having that happen to them. The price of those vehicles immediately go down because, the new car prices go down. So y- I guess the thing that not the, Tesla has the best profit margins in the country today. And even after those reductions in price, they still have the best margins in the industry today. So that tells you a lot about, the strength of that manufacturer. And so I I think there that well, as you I think can imagine, it can't continue. I mean, there is a point where you're not going to be able to drop your prices anymore. But that just tells you how strong of a again of a profit margin they had, where you could do that and still maintain profitability, and actually in a good way. I mean, it's still better than most of the OEMs. So I think I I hope it doesn't continue. I don't get the sense. I do think they're going to look at maybe small ones, and actually, that is some of the things that we're talking to them about, is how do we help them sell cars? It's all about, creating better, um, you know, better sales. One thing as a kind of a fledgling new OEM in the EV space, and they sold themselves. Now he's getting to the point, and Tesla's getting to the point where they have to do a lot more marketing and sales. And so I think you'll probably see subvention at some point. You'll probably see, you know, uh, more leasing programs, but I don't think you're going to see a lot more price discounts. You might see one here and there, but I mean, it was crazy last year. It was probably 5 in 1 year for the Y and the 3. Um,
Yeah, well, look,
so
especially if he wants to go into leasing. I mean, as I told you, we were talking before the call. I mean, with DealerTrack, when Auto Leasing Guide was one of our companies we acquired. I mean, just the discussion with the manufacturer about changing, trim and on a vehicle and the impact it might have 1 year to the next on residuals, and you've got a manufacturer that's dropping price like that, that would drive a leasing program crazy.
yeah, I think, again, if they were to continue that practice this year, if we saw 2 or 3 even price reductions on a model basis, I think you're going to just totally freak out the industry. I think from a leasing perspective in particular, like you said, you won't have anybody want to touch that unless Tesla takes 100% of the residual value,
Right.
it kind of risk. But uh, it's really an interesting phenomenon that happened last year. I've never seen anything like it. Have you? I mean,
No, no,
you know,
I remember when the BMW Model 7 changed its trim, and it hadn't changed it for probably 2 decades. And the conversations about the impact it was going to have from 1 year to the next, when they changed that cutoff back to a rounder back, what it was going to mean to everyone.
no.
So yeah, unless, look, maybe there's a market for Elon Musk to get into residual value insurance.
Well, as you know, there's only one player left in that, and it's just catastrophic stuff. There isn't anybody left in residual value insurance anymore, because it
Yeah.
it just became such a crapshoot.
So I was watching his research. I was watching one of the podcasts that you did, I guess it was Underground. And you were talking about the impact of COVID on consumer behavior. And I always think about Nigel Morris at QED. I went to a conference, a couple of years back, and Nigel got up. It was right after sort of things kind of cooled down with COVID, and he said, there are no more digital deniers after COVID, right?
Mhm.
And you talked about how COVID impacted the buyer experience, their ability to go digital. Do you see that continuing now? Do you see it getting
Oh,
better? Did it?
yeah, absolutely. I mean, you've seen the Cox, some of the different studies that are going on. I mean, people, it's all about kind of the early adopters sort of to that concept, and now more and more are definitely willing to. All the studies that we're seeing, the majority of people are willing to do the financing and purchasing online. Now, is it happening? I just saw a study that said, 50% of all the cars sold last year were in person. 43% were a combination of in-person and online, and only 7% were 100% online of buying a car. But all of those numbers are continuing to get, as far as what people are saying they're going to do in the future, they're all saying they'd be willing to do more and more online. So I just think you're going to probably see a lot more, test drive centers, I guess you could say, and then getting the car, online, especially all of these EVs. That's pretty much how they're all kind of growing up right now with that.
Tony, last question. So 2023, there was a lot of discussion about this NCUA financial innovation rule, and it expanded the way CUSOs could get into the business of lending. And it allowed them to take out warehouse lines and expand it beyond. I thought it used to be student loans and credit cards, but auto. What impact does it have on Origence and the credit union members that own you?
Yeah, well, that's what allowed us to do the FI Connect. We couldn't have done it without that change in the rule.
So that allowed you to become a finance company.
That allowed us to become a finance company. That also allowed us to do what we're doing with Tesla right now, because we are doing whole loan sales to credit unions. And there's other pieces of this, and participation also fits in there too, and some of the things that were modernized in this regulation. And they really needed to do it so that some of these new ways of financing cars could be done, and we didn't have to become a lender, a lender that services these things. We really didn't, and that's in the whole discussion with NCUA. We had to agree that that was not our intention, and it isn't. I mean, we wanted to actually try to get the loans and get them over to credit unions right away. So whole loan sales was a big piece of that modernization too. So they had a limit on how much they could do. Now now it's got much more of an easier way to do many more of those than just these set limits that they had on it. So it's
Tony, do you maintain a warehouse line to do this or not? You just fund directly?
We don't need to. It's all forward flow. It's all forward flow for our credit unions. Yeah, we
Makes sense.
yeah. Now I think it's a good model that'll help credit unions make loans. I think hopefully NCUA feels like it's a good idea that they made that change, because if they didn't do it, we wouldn't have been able to do what we're doing.
All right. Well, before we go, predictions. So Cox says we're going back to normal. We know we've got liquidity issues. Give us the prediction, Tony. What's 24 and 25 going to look like?
I kind of did already, but I think it's all about if rates come down. I think if rates come down, I think we're going to see a much more robust lending environment for credit unions. And I think it's when that happens. I think it's going to be a little tougher the first part of the year, like I mentioned, and I think it's going to get easier as rates ease up. The thing that's a little challenging from a credit union perspective versus banks and captives, credit unions when rates go up, they're slower to raise rates. When rates go down, they're slower to lower the rates. So I do have a little worry about that competitive, aspects of how we are going to be able to go. And, we hopefully are going to keep the information flow going between our credit unions to make sure that they're changing rates appropriately. But it is just, I've been doing this a long time. That is generally how it works. They're slower when rates are going up and slower to lower them when they come down. But now that it's on the other side of that slope, we would definitely want to try to get them, so we can stay competitive. But we'll see how that all plays out. But I do think it's going to be, we're in a tough cycle right now from this liquidity crunch. But I think it's going to get much better for credit unions. And they've always been big portfolio lenders. I mean, that auto lending is over a third of their portfolios today. And I think they see that as kind of, part of their brand. You sit next to somebody on an airplane, so you member of a credit union, and they'll say, I got my first auto loan at a credit union.
Right.
That's how we're known. So I think they want to keep that,
Tony, thank you. This was great.
Hey, Vince, thank you for having me. Really appreciate it.
Thank you, Tony. And we'll leave it there for this episode. I really enjoyed our conversation, and thanks to our listeners for tuning in. Don't forget to subscribe so you can enjoy future episodes, and I'll meet you back here for our next 22 Minutes in Lending.